This quarter, Google posted its numbers. Net profit up 298%. Cloud revenue up 82%. Big tech is sitting at a $23 trillion combined valuation. Every financial headline is saying the same thing. AI is working. It isn't. That 298% profit jump? Almost all of it came from a single $99 billion paper gain on stocks Google already holds. Not a dollar of it came from a customer. The revenue is circular. The profits are transfers and paper gains between the same companies. The GDP signal your macro framework runs on, it's broken. And the cascade, when this unwinds, runs straight through your index fund. By the end of this video, you'll know exactly how the circular financing mechanism works and who's running it, why the GDP number you're using as a bullish signal is now inverted, and the precise chain, Nvidia to Apollo to your pension fund, mapped out in the order it breaks. If you don't understand this mechanism, you'll buy every AI dip for the wrong reason at the wrong level, and you'll be long the most concentrated $23 trillion setup since the dot-com peak. Let's start with what the numbers say on the surface. Google Q2 2026, net profit up 298%. Cloud revenue up 82%. The company credited cloud and AI. The stock's near all-time highs. By every traditional metric, AI is printing money. So I pulled the actual cash flows, not the press releases, the cash flows. Here's what I found. Google invested billions into Anthropic. Anthropic then committed $200 billion back to Google Cloud over 5 years. So the customer paying Google for cloud revenue is Anthropic, and the customer funding Anthropic is Google. It's the same money going in a circle. Take $10 billion, cycle it between two companies 20 times. Each transfer gets booked as revenue. Each revenue booking inflates valuation. The $10 billion never changes hand in any meaningful sense. It just spins. Now cross-check the free cash flow. Strip out the paper gains on stock they already hold, stock compression, buybacks, and data center CapEx, and the reported earnings nearly disappear. Google's headline 298% profit jump was almost entirely a $99 billion equity gain. The profit is an accounting artifact of the cycle. Big tech's record profits aren't coming from customers. They're intercompany transfers and paper gains. That's what the cash flow statement says. 23 trillion in market cap, built on recycled dollars that never touched a paying customer. But here's what makes this so dangerous. That circular cash is showing up in macro data. The signal Wall Street is using to trade the economy, it's been compromised. If you run the numbers on US GDP demand growth, here's what you'll find. In the first half of 2025, 92% of the demand increase, 92%, was data center buildout. If GDP is trending up, that looks like a healthy economy expanding. It isn't. Right now, GDP is measuring one thing: companies burning cash on infrastructure. That infrastructure returns 18 cents on every dollar spent. We'll get to that number in a minute, but understand what it means for the indicator first. Rising GDP is not a green light. It's measuring the size of the burn. Multiple large data center projects have already collapsed. That CapEx still counted as GDP contribution before the projects failed. The indicator captured the spending. It didn't capture the failure. The Bank for International Settlements, the central bank of central banks. In late June 2026, the BIS issued a formal systemic risk warning specifically about AI spending and circular financing. The BIS doesn't do that for attention. They do it when they think the entire system is exposed. If your framework rests on GDP trend as confirmation, that framework is inverted. GDP right now is measuring circular cash destruction, not a productive economy. Revenue is circular, the GDP signal is broken. So what's the actual return on all this spending? We have a number, and it's worse than you think. Researchers surveyed 2,500 companies on AI adoption. One question: of every dollar you spend on AI, how much actually reaches production? Not 50 cents, not 30 cents, 18 cents. For every dollar companies are spending on AI, 82 cents never become a working product. It disappears into pilots, integrations that don't scale, tools companies abandon before launch. Starbucks rolled out an AI inventory tool across 1,100 plus North American stores. They dropped it. Catastrophic failure at full scale. Duolingo's CEO pushed an AI-first mandate to replace work with AI, then walked it back after the backlash. Even the people selling this don't believe their own projections anymore. Sam Altman said he would be delighted to be wrong about the AI job apocalypse. That's the CEO of OpenAI walking back the core commercial thesis. Now add the cost problem. The moat argument for US AI was always, we have the best models and they're too expensive to replicate. That argument is gone. Chinese models close the performance gap. DeepSeek, Qwen, Kimi, good enough for most production applications. And they cost a fraction of the US alternatives. Cursor switched, Coinbase switched, Shopify, Airbnb, Uber Eats, Siemens, Microsoft, all switching to Chinese models for production workloads. The ROI is 18 cents on the dollar. Those production failures have names. The cost moat is gone. And the executives who built the bull case are quietly walking it back. So here's the question that matters. If revenue is circular, GDP is inverted, and the ROI is 18 cents, who holds the bag when this unwinds? In what order do they fail? Michael Burry expanded his bearish Nvidia position in 2026. Burry doesn't short randomly, so let's map the chain he's betting against, because it doesn't end at Nvidia. This isn't a tech trade. This chain runs through your pension fund. Here's how it connects. Nvidia sold $5.4 billion in GB200 chips, their flagship AI GPUs, to a company called Valor. Valor buys and leases data center infrastructure for xAI, Elon Musk's AI company. xAI's financing runs through Apollo, private credit. Apollo's credit base includes Athene, an insurer. Athene's reserves are pension fund capital. So when Nvidia orders drop, Valor defaults. If Valor defaults, xAI's infrastructure collapses. If xAI collapses, Apollo's credit book is impaired. If Apollo is impaired, Athene's reserves erode. If Athene erodes, pension funds take losses. If pension funds take losses, institutional managers have to sell index exposure. Now you've got NASDAQ margin calls. Then there's SpaceX, a rocket company that just pulled off the largest IPO in history, crossing a $2 trillion market cap on day one. SpaceX merged with xAI in February 2026. xAI valued around $250 billion. Their SEC filing lists the primary business as computer programming and data processing. 85% of their proposed addressable market, they call AI. The first acquisition after the repositioning? Cursor, an AI coding company, for $60 billion. A $2 trillion AI IPO for a rocket company that just paid $60 billion for an AI coding company because its own Grok coding flopped. Here's the cascade in order. Circular financing stalls, CapEx collapses, Nvidia orders drop, Valor and xAI default, Apollo gets impaired, pension losses hit, institutional forced selling triggers index futures margin calls. And SpaceX, now xAI's parent company, just floated the largest IPO in history, a $2 trillion valuation on the back of it. Roughly $23 trillion concentrated in the Mag 7. This doesn't resolve as a tech correction. It resolves as a recession trigger. The BIS named it. The cash flows confirm it. And we just mapped the chain. The question isn't if, it's the sequencing. You now know that the AI revenue boom is a circular financing scheme. And you can trace the exact cascade from Nvidia's order book to your index fund in the precise order it breaks. But knowing that forensic case isn't the same as knowing what price is doing right now, or when this story actually becomes a trade. Here's what understanding that story also doesn't give you. The truth about price. It gives you a narrative, and narratives matter. But price is what tells you whether the narrative is true or not. The measured move is a framework for understanding the direction of price. It tells you whether this narrative is being confirmed by price or not. If you act on a story like this without that framework, you could be right about everything you just heard and still be on the wrong side of a trade for days, weeks, or even months. That framework is what I teach. The traders in my community don't get trapped by bearish narratives. They know where a trend fails, and until it does, until price confirms it, they will trade a bullish trend until it fails, even if it is against a bearish narrative. They have a framework for reading it themselves. That's the process I teach every day at eminiaddict.com.